Hello everyone, welcome back to the channel. Today we are discussing 10 classic mistakes that investors make, mistakes that even smart people fall in. Warren Buffett, one of the greatest investors of all time, has shared timeless wisdom on how to avoid these traps. But instead of just listing them, I'm going to break it down with some kind of a relatable examples, especially in our Indian market context. So let's focus on this one, and this is purely going to be eye opening for you if you are a beginner for the investment, or if you are feeling kind of depressed or worried about the falling market. This is for mainly for you guys. So watch this video fully and you will get good insights from this one. The method I'm going to tell is I have experienced, and based on my experience only I'm going to provide all this insights. So let's get into the details. And if you have made any of these mistakes which I'm going to tell now, don't worry, you are not alone. I'm here. I have also come across all those things. Let's discuss in our comments and let's get into the detail about this video. And this is Sundar and you are watching Mindful Finance. Okay, the first mistake, what is here? Keeping too much cash. So this is the first rule or the first mistake we encountered or still encountering, still facing with our family members. Everybody like forced us to do certain things. Like even Warren Buffett says that cash is like oxygen. You need to, but you need it, but don't hoard it. So in our real scenario, if you see, right, we all have that one old fridge or cupboard which is filled with n number of things which we don't use. Or if you get any kind of parcel or anything, that the plastic covers or whatever we get, right, the carry bag, so we store it in one place but we never use that one. We don't even know when we are going to use. All those scenarios you would have encountered, right? So similarly, people hoard their like too much of cash. Like they feel like having too much. Like every saving in your bank, every day you need to see the bank account need to have at least this much of money or something, and they simply dump their money in the savings account or some of your in the shelf or something, right? So thinking it's a safe, but the truth is inflation slowly eats away the money. For example, if you keep it in a shelf or something, your old material gets spoiled, right? Similarly, your cash also erodes because of inflation. For example, if you see, like if you gone back and check your grandparents or someone would have bought a flat or home just for 5 lakhs in the 1980s, but today it might be worth of 2 crores. So just imagine if they would have kept that 5 lakhs in cash till now, what would be the worth of it? So while you must have an emergency fund, that rest of your money should be invested in assets that grow like stocks, mutual funds or real estate. So don't dump in your fridge, in the backside of your fridge, which you never going to take it back. The second, blindly following the others. In my neighbor, right? I have discussed whenever like I go to pick my bike or through lift. If I meet someone, they immediately ask, "Hey Sundar, how are you? So tell me like what is the stock? What do you feel is good now?" Right? People start to pull things from my mouth. Right? I try to avoid those kind of scenarios. But mostly, what happens is if someone tells, if your neighbors talks about some stock, suddenly they get more attached towards that. They think that, oh, my neighbor made money in this stock, I should invest too. That mindset will create in our background of our mind. So this is the classic example of herd mentality. It's like going to a wedding buffet and seeing a long queue at one food counter and simply joining in the queue and without even knowing what the food they are getting from. There might be multiple queues, but we just see which is the biggest, lengthiest queue and just we follow because we feel that queue is going for a very good food, right? So that is the herd mentality. If you remember the 1990s dot-com bubble, like people who born before, they know that, like 90s kids may not know that, but this was a biggest problem we faced during the 1990s. And similarly in 2008 we faced a problem in real estate. Real estate was booming and suddenly it fell like anything. So the main problem is, just because everyone is investing in stock doesn't mean it's good for you, right? Always do your own research. That is the important point. The third mistakes, buying too many stocks. If you go to Rajasthan food or something, right, like what is it, Chokidani. If you go to Chokidani, I visited multiple times times over there. Like the food they serve, right? I like that seriously. I like that hospitality of the thing, but the too much of food, right? Like ghee and everything, it overshadows. End of the day, like I can't even able to recollect or remember what are the foods I had. So the experience you get in Chokidani is good, but the food they serve, right? It's the hospitality is good, but the end of the day, I don't know what food I had, and after going out of Chokidani, I don't know what food to ask from any of the restaurant which I had before, right? So this is the problem. Okay, everybody says, Warren Buffett says that diversification is protection against ignorance, which is like some investors think that buying 50 to 60 stocks will protect them from risk, but that's like ordering the example I told, right? Like a thali of 20 items at the restaurant. You can't enjoy any of them properly, right? So if you have only like if you go to any shop like Madurai, Murugan Idli or somewhere, they serve only idli. That idli taste you will not forget. The tatte idli, if you go to Mysore, right, on the way you get the tatte idli taste, you'll never forget. You just had only one, but still that memory will stay in your mind. That will not erode. But till now, I visited like 4 times to Rajasthani Chokidani food. I don't remember. I have photos of them, but I don't recall. So whenever I go to any of the Rajasthan food, I just show them, okay, what is this food is about. Okay, that's my personal experience. I'm not telling bad or anything about it, but it's just an experience that you should remember that. So imagine if you invest 10,000, invested like 10,000 in 50 different stocks. If one of them doubles, it's not going to make any difference. It will make very little difference in your overall portfolio. But if you invest just simple 5 to 10 great stocks, each one has a meaningful impact. So always think this one: quality is greater than quantity. Focus on a few great business that you truly understand. You should be able to easily recall that stock or what you bought or what you experienced. This is the biggest one, the fourth mistake: trading too much. It's like the term is like traffic jam investor. It's called like frequent trading is like switching lanes in a traffic jam, thinking the other lane is always faster. So you pay extra taxes, brokerage fees, STT, and you just end of the day, if you see you would have made a firefighting to solve your problem and you ended up in profit. But if you go back and check the number of stocks you bought and sold, that money will be like more than the profit you earn from your trading, right? So the study you would have already seen that Zerodha website or any portal, if you go and log in, they'll say that 90% of day traders lose money, right? The stock market rewards for patience, not for speed. So investing is like planting a tree. So you have to give it time to grow instead of uprooting it every day. It's like the concept called bamboo shooting, like bamboo trading. This the method. You have to wait. The patience is the game. That's a story also, right? The bamboo takes 3 to 4 years to build its root. You won't see any growth in the stem, but suddenly one day it will grow 10 feet. That is the power of bamboo bamboo shoot investing. So don't trade much. Focus for staying in the market for long rather than having more adrenaline or focusing on more adventurous kind of a thing. Fifth, always I seen experts or who are like talking in the market, right? They say like I predict things properly, right? So this is the thing, like timing the market, waiting for the perfect mango. You see, like whenever it touches the support, I buy. Whenever it touches the resistance, I sell. I'll wait for this to reach this level. People try to predict all this thing, right? And I'll wait when the market crashes 30%. So waiting for the perfect time to invest is like waiting for the best mango of the season. By time you decide, someone else has already eaten it. So if you have invested rupees 1 lakh in Nifty in 2000 and just left it alone, today it would be worth around 18 to 20 lakhs. If you kept waiting for the perfect time, you would still be waiting. So start investing today. The best time to invest was yesterday actually. The second best time is today. So this quote I have in my laptop wallpaper. That remains always this thing. Like whatever thing you wanted to do, right? It's supposed to, you should have done yesterday, but you have another chance, which is now. Don't wait for tomorrow. So that is the main thing. So next one is investing without understanding. The metaphor is gym membership mistake. I know like a lot of people have gone to gym and paid the membership like 6 months membership or 1 year membership. They pay it in a bulk. without even understanding or without even knowing why they are paying that, why they are getting into gym first, what is their vision, what is their goal, what are the journey they are going to have during the gym membership, what are the pain they are going to face, what are the mental struggle they are going to have, how the discipline is going to be built, right? Without knowing anything, they just pay, but after 2 days, because of pain or something, they will stop going gym, right? So people invest in high-tech stocks because they hear words like AI, blockchain, or metaverse, even if they don't understand the business. So the main lesson here is only invest in business you understand. If you can't explain what the company does in one sentence, don't buy it. Go and tell to your son or daughter, who are 10 years or 12 years, and explain about that company. If they are able to understand that company, you can invest. If you are not able to explain to them, and if they are not able to understand, hold it till you understand the business. Don't even enter into that. The people who are good in retail business, they go and invest in pharma or IT. They know about retail business, but they go and invest in some other thing. Why just focus only on retail? Like you would have focused only in retail from very long time, like 10-15 years. Dabur, ITC, Hindustan Unilever, Nestle. That one sector is enough. You would have built your wealth. Don't even think about any other sector. Go with one sector which you know properly. Don't just go and jump around all the sectors, and don't try that. It's called diversification, and don't get burnt your money. So that is a very important one. Invest in business you can explain to anyone in one sentence. This is the another funny thing. Fake WhatsApp forward or trusting experts blindly. So we have all received those forward this to 10 people and become rich, right? Like double tap and you'll get something, right? So some stock market experts are like that, always predicting the next big crash or bull run, but they are wrong most of the time. Peter Lynch has told that in one of his in his book also, that people try to wait for the next big crash or the next bull run. There are almost 90 crashes have happened before, right? Like 5% to 10% to 20% kind of a fall. Most of the time they would have missed that. They would have they would have missed the chance, and after that they say, I predicted that one, this will happen. I predicted that this will happen, but they themselves would have missed those opportunities. So in 2020, when the stock market crashed, experts said it would take years to recover because there was a COVID time. The entire world got into food, right? But what happened? It hit all-time highs within just in a year, not even a year. Within a limit only, within a year only, it bounced back. So the lesson here is learn to analyze companies yourself instead of blindly trusting self-proclaimed market gurus like I'm the best, I know everything, right? So this is very, very important. There is nobody can predict the market. Don't forget that. Nobody can predict the market. Write it in a big wall, in a big bold sentence. Nobody can predict market. So next point is thinking more risk. Assume that if I take more risk, that means I'm going to get more profit. It's a metaphor is called a spicy food challenge. Like some people think high risk stocks are always high returns, and that's like assuming the spiciest food is always the tastiest. But remember that sometimes it burns your mouth. So take calculated risk. Risk is good, but add this word calculated risk. So high risk doesn't always mean high reward. This is very, very, very important. You need to have calculated risk. You need to have proper system in the place that this is because if you invest 1,000 rupees, your loss is maximum 1,000 rupees, right? Because investment you made 1,000 rupees. The reward could be 2,000, 3,000, 4,000, 5,000. But the calculation of 1,000 rupees risk, you should know that this is the risk I'm going to face. If I lose, I'm going to lose 1,000 rupees. This clarity you need to have before investing. So the point here is take calculated risk. High risk doesn't always mean high reward. This is very, very important because I myself faced this one in my earlier days. Okay, selling too early. This is like a half-cooked biryani mistake. You don't know like whether the biryani is cooked or not. Before, if you have the dum biryani, that smoke has to start coming, right? Before that, even like opening and checking whether it has cooked or not, you know that the smoke has to come through that dum, right? That cover from the lid. If the smoke is not coming, two things can happen. One is overcooked or one is not cooked, right? Sometimes the lid might be tight and the smoke might not be coming out. That is is also the reason. Okay, anyways, we don't need to get into that one. But again, many people sell the stocks too early, thinking they have made enough profit. Just imagine if you have invested 10,000 in Infosys in 1993 and sold after doubling your money, you would have missed out on 5 crores today. They would have got they gave a lot of bonuses, split, a lot of things happened, right? So now the worth would have been more than crores, but 10,000 would have been doubled to 20,000 at that point of time, and you exited that. But if you waited for time, so you need to give time for the business to grow. Don't exit early. If you have confidence in that business, you should know, like for example, the stock went to 100 rupees. See example of Tata Motors, right? It went to 1100. Now it is crashing, it is going down. You should know that the stocks market will crash. Without accepting that fact, don't get into any company. That is how the stock market works. That is how the market behaves. It will correct. It is the behavior. When correction happens, again people will buy and it will market will go up. Just check whether the company is doing good or not, whether the business is good, whether is there any debt, is there any problem in the company. Without even knowing what you bought and why you bought, don't even enter into the market. Then you are not the right person to be in stock market. If you are getting panic, if you don't know what to do when the stock market is crashing, for example, Tata Motors went to 1100. Now it is 700. If you don't know what to do now, then you are not the right person to be in stock market. Yes, you don't know why you selected this company. You don't know what is the logic behind that one. You are not tracking that company. You are not having interest in that company. If you have interest, you yourself would have gone and explored that market. Like why is Tata Motors is crashing? What happened to it? You will not expect other person to come and tell that whether I should exit now or I need to buy more or etc. Right? Please do your homework. Don't expect other person will come and help you out at every time of your life. This is very important. Don't try to get half-cooked biryani. The last thing, not investing in yourself. Warren Buffett gives an example that if you get one car, okay, don't worry about the worth of the car, but this is the car given to you and told that this is the only car you are going to have till your life. You will not get any other car. Now what will happen? You will try to maintain that car properly. You will clean it, you will maintain it, you will service it, right? Like your body, it is given to you. It's a once in one or lifetime. This body is for you for only one time. You will not get this body again back. So the one thing given to you has to be maintained properly. If you are not maintaining, if you are not caring about yourself, then we cannot tell anything, right? So many people think that learning stops after college, but even Warren Buffett says his best investment was improving his own skills. So keep learning, read books, watch videos, and stay financially educated. So conclusion is, at the end of the thing, we learn like now 10 points we learned, right? Now assume that everybody knows this cricket analogy, right? You don't need to hit every ball. So investing is like cricket. So you don't need to find and invest in every stock you find or everything you heard, right? Go with one good company or 2 or 3 companies, and when for the right opportunity, okay, then you should go for the 6. So avoid this 10 mistakes, stay patient, and let your investments grow. And if you are face this similar problem, just comment below and which mistakes have you made before. So let's learn together. Do like, share, and subscribe for more this kind of interesting information. Thank you.